Well, stock markets, as you can see, are in positive territory this morning after a wild ride yesterday that saw major North American indices swing between steep losses and briefly, as we've noted, big gains. But the source of market volatility, Donald Trump's tariff assault on the global trading order, shows no signs of easing. Let's welcome our featured guest of the morning to talk about it. He's Gavin Graham, Chief Investment Officer and Portfolio Manager at Spire Wealth Management. Gavin, great to have you here. Thanks very much, as always, for joining us. Let's begin, Gavin, with today's positive tone to equity markets. We just showed viewers the U.S. futures. They are up by close to 3% apiece. The European markets are higher as well. How should investors understand a day like today after a week like we had last week?
Well, I think it's understandable and good to be here again, Paul, because you'd seen one of the three biggest sell-offs this century on Thursday and Friday after President Trump's announcements of his tariffs on Liberation Day, as he called it, down more than 10% in 2 days. And when we saw, as you mentioned yesterday, there was a false report that tariffs might be paused for 90 days except on China, the market turned around from being down another 5% to being up around 3%. It gave that up once it was denied by the White House, but it shows that the sell-off has been so sharp and so extreme that investors are actually looking for any potential good news to get back in, because there's been a lot of damage done. At the lows yesterday, we are actually in a bear market in that we were down more than 20% from the highs, and a fall of that magnitude in that shorter space of time, because we are only, actually, it was mid-February, hard to believe though it is, that we were at all-time highs, that realistically we're going to be looking for any opportunity to buy.
And that was my next question. A lot of investors, I think they understand that selling at this point is not wise. They would be locking in losses were they to sell. Should they be buying now, or how should they think about that choice of whether to buy or not?
Well, that depends so much on individual circumstances. What one can say is, and I think you and I have discussed this over the past few times I've been on, Paul, you ought to have been taking some profits because you were up 25% 2 years in a row in the US markets, and even in Canada, you were up a fair amount as well. It's never wrong to take a profit, especially when the valuations on stocks were at the third highest in the last, again, 25 years or so, the internet bubble, and then before that, probably in 1987. So markets were looking expensive, and effectively somebody described them as a balloon waiting to pop. And President Trump's tariffs were the pin, a very large pin, that caused them to be popped. So it makes sense to say that you ought to have been taking some profits. There are things that you can look to buy, and we'll be talking about them a little bit later, I'm sure, in this segment. But the realistic thing to say is you ought to have been rebalancing on the way up. You should always look at where you started from. What was your allocation to equities? What was your allocation to US large cap? And if it's got out of line because it's gone up so much, that's very nice, but take some profits. And if you have to pay capital gains tax, well, that's because you got a capital gain. Never wrong to take a profit.
Do today's markets point to the importance, Gavin, of having some cash balance that you're able to deploy when situations like this arise?
Absolutely. And again, the rule of thumb is you want to keep several months' worth of cash on hand. That's not always realistic for everybody, but certainly, again, if you actually at least have some cash available, then when buying opportunities do come along, you've actually got some ammunition to do it. One of the things one should say, and it's interesting that we actually saw a bit of a rebound in bond yields yesterday, having got below 4% on the US benchmark 10-year Treasury. It may be that some of that was perhaps forced selling, because one of the things that happens when you get this bigger sell-off so rapidly is you get margin calls, and it's not a question of selling what you want, it's a question of selling what you can. And one of the things that you could sell, obviously, was government bonds, because A, they've gone up, and B, it's a very liquid market and there was no disruption in that market. So that might possibly account for some of the move upwards in bond yields after the market sort of hit their bottom around 10 a.m. yesterday.
A lot of the most highly regarded stocks in the U.S. stock market are a lot cheaper now than they were just a short time ago. Here are two examples: Amazon.com, JP Morgan Chase. Analysts and professional investors hold both companies in very, very high regard. The only issue that they have at times with the stocks is that they sometimes say, in particular in the case of Amazon, that it's fully valued. Well, they are we're looking at Amazon right now, substantially cheaper than it was just a week or so ago, and very substantially cheaper than it was in early February. Same thing in broad strokes with JP Morgan Chase. How should investors think about these quality names that are on sale right now?
Well, without wanting to disagree too strongly, Paul, saying that they're cheaper, the price is lower. Does that make it cheaper? Well, what is the outlook for their earnings? Because one of the reasons for the sharpness of the sell-off after President Trump came out with the tariff announcement was, what's this going to do to earnings? And if it does lead to snarl-ups in supply chain, if it does lead to increased costs, somebody's described it as throwing a wrench into the gears of the world economic machine. Are those earnings estimates as reliable as they were? The fact that the price has gone down does not necessarily mean it's cheaper. It may just mean the price has gone down because the earnings have gone down, and therefore it's appropriate. It should be selling at a lower price. So I think you probably need to go through sector by sector and say who's going to be worst affected by the effect of these tariffs, should they remain in place for more than a few months. Because, of course, with the uncertainty about the Trump tariff policy, you really don't know. And therefore, it's very, very hard to make any substantial judgments about, oh, stocks are cheap now, if you don't know what the outlook is going to be on tariffs in 6 or 9 months' time.
Good point. Gavin Graham is Chief Investment Officer and Portfolio Manager at Spire Wealth Management.